Yeah, good afternoon, ladies and gentlemen. Thank you for coming. In the next couple of minutes, I will guide you through the presentation of the energy sector. We will cover a review of the last fiscal year and an update on the progress on Aspire 2027. We will talk about the market environment, our strategic priorities for the next couple of years, and our future ambition and conclusion. Last year, we have delivered record high orders, revenues, and profits, which has led to the decision that we have upgraded our plan for Inspire 27 going forward. And of course, we have established the service business unit inside of Hitachi Energy, and we will come to that. Our priorities for further growth and transformation are continuous solid execution of our order backlog, generated record high revenues going forward, and delivering more profits. If you're coming to the business to the market. Sorry. If you're looking at our strategy going forward, it's based on 3 pillars. Strengthen the core, accelerate strategic growth, and leverage AI for our businesses. Strengthen the core covers operational excellence, so how we are producing our goods and services for our customers. Continue investments into capacity expansion, looking for M&A and partnerships going forward. Accelerate strategic growth means, yes, we want to become #1 in service growth. We want to play a role in areas which have extreme growth, like data centers going forward. And leveraging AI and digitalization means how we can improve our operations and our internal processes and leverage AI in that thing. And of course, looking at SMRs, which is a booming business. Coming to the market environment. The market environment is very favorable. If you're looking at the energy consumption worldwide, the primary energy usage is continuing to grow with the GDP. But the underlying electricity consumption is growing much more. You see it's more than doubling up to 2050. This drive for electricity and for electrification is, of course, based up by figures of investments. If we look at the investment climate in the last 10 years, you see that investments in fossil, like gas, natural gas especially, and coal, etc., are going down, and investments in renewables, electrification, and grid expenditure are going up significantly. You see the numbers. Renewables have doubled. Nuclear has started to grow as well, 1.7 times. Electrification, 2.4 times. And of course, the economic and political environment we have on our planet at the moment, which is quite volatile, I would say, is driving that the space of renewables and nuclear is even growing more than we have assumed. You see on the right upper part that the participation in the electrification of renewables and nuclear is growing extremely. And that's good for our business because the components we are delivering, which are needed for this electrification, is that what we are doing, and they are growing exceptionally well. You see transformers will triple in the next couple of years from 2020 to 2050. HV switchgear 3 to 5 times. HV-DC links quadruple. Battery electric storages more than 10 times. STATCOMs 5 to 10 times because power quality problems are going hand in hand with renewables. Power electronics 6 to 8 times. Software solutions will become more important to balance the grid and maintain the volatile generations. Service more than 6 times because we have aging infrastructure, we have less and less people for our clients to work, and SMRs will grow 5 to 7 times. And that's, of course, reflected in our market projections. If you look at the left side, Hitachi Energy market in billion US dollars, from 2017 to 2020-21, it was rather flattish in an area of 100 billion, and now it's growing significantly. It will reach in 2030 around 350 billion, so more than triple. And nuclear is just at the brink for these investments. The lowest values you have seen in 2005 with 11 billion investments into nuclear and technology. Now it's at 90 in 2030. And of course, you have seen already the first FID for an SMR in Canada. So this business will definitely take off. So what are our strategic priorities? We are #1 with our installed base. We have installed more than 500,000 assets in the electrical area over the last decades, 240 billion US dollars. But we are not #1 in the service area. It's our goal to be that, and that's why we have founded the service business unit last year, and we will report what our first success is. In nuclear, we are strong number 2 in the Japanese market. 2/3 of the boiling water reactors are in our portfolio, and all of the generation 3, so of the advanced boiling water reactors, have involvement from Hitachi. In the other areas, transformers, high voltage, grid integration, and grid automation, we are clearly number 1 in the industry, clearly from number of volumes. In some of the areas, we have nearly the double installed capacity of the next competition. And of course, we have grown from 2021 to 2025 around 20% CAGR, far beyond the market. So we have definitely a very good global footprint, and we are in some of the technologies a clear technology leader. If you look at our performance from a monetary point of view, in 2020, we have $9 billion revenue. We closed the books last year, 2025, with $20 billion, mainly based on capacity expansion and better services. And we are projecting now, or we have upgraded our projections for the year of 2030 to $36 billion revenue. Of course, if you talk about the revenue growth, that's one thing. But if you look at the backlog below that, you see a slight different or interesting picture. In 2020, the backlog ratio to revenue was around 1.1. 11 billion order backlog, 9 billion revenue. In the last years, we have recorded record order backlogs. Last year, we have closed the book with 20 million revenues, but with 60 billion order backlog. In 2030, we expect on a revenue level of $36 billion, more than 100 billion order backlog. And this does not include capacity reservations and framework agreements. That means the order backlog has changed in its nature. It's more complex. It's more forward-looking. So we have clearly a visible line now for 2-3 years or sometimes 6 years, based that our customers are now ordering equipment way ahead of time because they know that supply and demand is not in balance and they want to select their slot for their products and services. But that means that if we're looking ahead to a fiscal year, the majority of our revenues are coming from order backlog. So we know nearly for the complete year what we have to produce, for whom we have to produce it, where we have to produce it, and how we have to produce it. And only a small part is book to bill. So we have to continue in our strategy to deliver the order backlog and focus on capacity expansion and other things. So coming to capacity expansion, we have already invested $3 billion from 2020 to 2023. We are in the process to invest another $6 billion until 2027. And you see on the map, it's a global investment. We are investing globally on all places where we have a footprint. At the moment, we are investing currently in more than 40 brownfield and greenfield factories. So brownfield means we are expanding an existing factory to the maximum capacity while we are producing. So we are producing and building, and we started some greenfield factories. I think it's clearly to say we follow a clear strategy here. We only sell to our customers what we have and what we can produce. We're not canceling orders for our customers. And we're only investing into new factories if we have a bankable business case, if we have enough backlog to justify an investment and make it bankable. If I'm telling you that the order backlog conversion into revenue is the key to success, then of course operational efficiency is our internal key to deliver revenue. And we follow here a single approach. We started already years ago to organize all our activities based on one single ERP system called REVA. REVA is online since 2 years, and the last year have focused very much on drive synergies and cost improvements out of REVA. What means one single ERP? It means that every factory, every country, every project, every customer, every supplier is in one big database where we have access to the data. So we know what is happening. And we have used this for improving our internal processes. That has driven results of $150 million US last year as productivity gains, which has hit the bottom line and will continue to hit the bottom line. The next phase was to using that system to de-risk our supply chain. We all know that the world is very volatile. Every day is something happening, and we started to connect a system called ResiLink, a product which puts us on notice for every natural disaster, tsunami, volcano, for every closage of any transport way, like a Suez Channel or Strait of Hormuz, and directly informs us. And we know what kind of logistic chain is impacted. We know which customer, which factory, which route we can optimize or where we can act before we really see the impact. That flexible rerouting and supply has generated, of course, more revenues because we could deliver faster. And that has hit the bottom line with $200 million bottom line effect last year, and that will continue. And now we are starting the third level, process optimization. We're changing our manufacturing approach from managing to order to managing to stock to cut actually the delivery times, reducing lead times and optimizing our portfolio. We started a company-wide end-to-end process digitalization using Celonis and AI to look which processes can be improved. And we're using embedded AI agents to make our internal processes more efficient. Why is it important? If we are growing around 10 to 15%, of course, we don't want to grow our general and admin expenses at the same magnitude. We want to keep them rather flattish, and that will have a bottom line effect of around $250 million going forward until 2030. So overall, if you make the numbers, operational efficiency and AI will drive a cumulative profit impact of more than $2 billion by 2030. With the remaining impact on our revenue generation, what is not coming from backlog, book and bill, we are focusing on high growth segments, like in service, where we have grown our business 20% last year, focusing on data center, fast growing, fast execution, 150% growth last year, selling innovative products like Iconic, with more than 1,000 products sold, and focusing on SMRs. If we're talking about service, service is important for us because we have the hugest installed base in the industry, and our ambition is and was to double our service impact and service revenue until 2035 to more than 30%, which means that in 2030 we have to drive around 6 to 8 billion revenues in service, organically and unorganically. Last year, we established the business unit. More than 6,000 colleagues joined the new organization. The business unit is up and running. The processes are working. And we have grown the business last year organically around 15%. And if you add the Chemco investment with equity accounting, 20% growth. So fully in line with our business plan expectation. And of course, we have announced HMAX last year in March on the CERAWeek. Why HMAX is important? HMAX is an enabler for service revenue recognition and enablement in Hitachi Energy. We can help to plan, predict, and prevent, and that's the base for customer intimacy and customer retention. Just to give you one example or two examples, Tata in Thailand, we have sold a sensor monitoring system which reduced the failure rate of 60% by just knowing what is going on. Second example, ERG in Italy, a digital-enabled service agreement where we can reduce the time on site by 35%, or digital twin for an HVDC link between Germany and Sweden, where we can react much faster to bring any line back online and saving money for our customers. The other high growth area is data center, driven by a high demand for AI data center worldwide in Americas and in Asia. We are able to nearly double our revenues in data center, and we're projecting a growth in the area to 4 to 5 times. We are uniquely positioned due to fast delivery times. So we have started to standardize our offerings, to containerize it, that we can fast be delivered and produced. We are very flexible with that. And of course, we have started to look into solid state transformers for 800 volts DC or other voltages required to really fast and space-consuming solutions to be deployed. We have a global footprint and capacity expansion is helping for that. If you talk about numbers, we have started in 2025 with a profitability of 13.4 EBITA. And of course, the volume leverage, significant capacity expansion, the high growth markets, they will lead us to our margin bracket in 2030 to between 16 and 20%. Even if we spend a little bit more on R&D to keep our leadership in technologies, we will be in that margin bracket. And our assumption at the moment is that in 2030, we will hit the upper end of this profit corridor as announced. Coming to the conclusion, on that slide you see the overview of the figures as presented, just for your information. The energy sector at all is projecting a CAGR of 14% going forward, so being in line with the updated Inspired 2027 and an outlook for 2030. Our EBITA in percent will grow into an area of 14% plus as forecasted and grow further, and we're striving to reach an ROIC of 25% or more. With that, we have significant market tailwinds. We have a very favorable environment, which is driving our profitable and sustainable growth and profitability. We have high capital returns and definitely value creating. Thank you very much. I think I'd like to announce two things before my next speaker. If you're interested in the Hitachi energy business, there will be a capital market day in autumn this year. We will let you know when and where. And with that, thank you for your attention, and I hand over to Giuseppe.